BlackRock is the largest asset manager in the world, according to Morningstar, with $9.57 trillion of assets under management at the end of March 22. Products mix, according to Morningstar, is fairly diverse. They have 53% of the firm's assets in equity, 28% in fixed income, 8% in multi-asset class, 8% in money markets, and 3% in alternatives. As you can see by the fast graph fundamental analyzer software tool, earnings per share have grown very consistently at a strong above-average rate of over 15.8% since 2001. You can also see the company currently has a 3.22% dividend yield, which is a very strong yield in today's market, even in spite of the fact that the Fed is raising interest rates. But because the Fed is raising interest rates, we also create an opportunity. When I correlate weekly closing stock prices over this 20-year graph, you see a real strong correlation. Price goes where the company's earnings go. But this is a quintessential example of a dividend growth stock. The white line is dividends, and you can see the dividend has consistently grown over this time and is currently yielding 3.22%. You can also clearly see periods of overvaluation when the time to invest was not optimum, and you can see undervaluation when the time to invest is optimum. And now you can see that BlackRock has come into fair value territory for the first time in the last couple of years. So it's one that's worth looking at. Hello, everybody. This is Chuck Carnevale, co-founder of Fast Graphs, the Fundamentals Analyzer software tool, aka Mr. Valuation. Once again, proudly bringing you a Subscriber Tuesday request series. And, you know, this series is actually growing and it's becoming almost unwieldy. I don't mind telling you that. But I also, at the same time, want to tell you how much I appreciate the participation and the fact that subscribers are asking to see certain companies, because it's really given me a good insight into seeing what you're looking at. But this week we had over 60 requests for various stocks. And I broke those down into dividend growth stocks and growth stocks. And I'm going to do a two-part subscriber request this week. I'll do it Tuesday, then I'll do another one on Wednesday for you. And I broke it down into dividend growth stocks and technically growth stocks or total return stocks that have little or no dividend income. So today's Tuesday group is going to be on the 10 quintessential dividend growth stocks. Now, what I want to point out is these are stocks that you asked for. These are not stocks that I'm recommending. I want to be very clear about that. These are not stocks that I'm recommending. However, it's very interesting that some of the stocks that you guys have asked to see, because there's some really interesting candidates in here, and I'll kind of comment on that as I go through this. But I'm really showing you just a quick peek. I'm just touching the surface of these stocks and simultaneously interjecting some of the ways that you can use the Fast Graphs Analyzer software tool and how it can help you make investment decisions, instantly that might be, commensurate with your risk levels and your tolerance for risk and your investment, and more importantly, your investment objectives and goals. So let's go ahead and get started into the presentation here. Let's look at our first company. I guess it's ACCO Brands Corp. Now, I really enjoyed seeing this one because I don't know anything about this company. I've never looked at it before. But what I saw here, what I found here was exactly what I think one of the great benefits of Fast Graphs. First of all, this stock, when it first went public back in, looks like 2005 or 6, it came out excessively overvalued. And then, after time went on and the fundamentals started to really manifest and you started to get a fundamental history, you can see that the earnings fell for the first 3 or 4 years. And of course, the stock price reacted very strongly to that. And then the earnings kind of went nowhere. They did pay a dividend for a while, and they now currently offer a 4% dividend yield. But note that there are no forecasts. I guess the analysts don't feel like the dividend has been predictable or reliable enough for the company. But the company does look very cheap. Has a blended P of under 5, earnings yield of over 20%, and a dividend yield of over 4%. So I would call this an interesting speculation. This just simply means this is the dividend historical, and this is the forecast, and we're just not getting a forecast of dividends. It doesn't mean they're not paying one. It just means that the analysts aren't giving us an estimate. So the stock looks very cheap here. Even at a more normal 15 PE ratio, there would be enormous money to be made here. But I do want you to note the cyclical nature of the company, the very, how inconsistent it has been. And one way you can always check that is by looking at the analyst scorecard. You can see that their analyst scorecard on 1 year forward forecasts and 2 year forward forecasts has been somewhat spotty. So this is one that I'm not particularly real excited about. I don't know that I'd want to spend my time, but for those of you with a little, more aggressive natures, perhaps it might be one that you want to look at. Anyway, I was asked to show it, and I hope you get a perspective of, how the company has performed historically. This is Air Lease. Air Lease is an interesting company. Now, one advantage of the Fast Graph tool also is you can go directly into external links and go directly into the company's website. You can learn about the company if you don't know something about it. This company obviously leases aircraft, and it has a really good track record from COVID. After COVID, we had a couple of really bad years, and that did cause, some angst with the investors, and the stock, didn't perform very well. It flash crashed during COVID like a lot of stocks do, recovered strongly, and it's been kind of in a downtrend after it really peaked out, here in April. But the company does have a good growth rate. Now, I'm not calculating it here because of negative numbers, so if I shorten this time frame, again, another advantage of the tool, this is an analytical tool. Use the tool correctly when you're analyzing stocks. I've got about a 15% growth rate. I've got a forecast growth rate of over 20% going forward, and there is no long-term growth rate being provided by FactSet. So for the next couple of years, we're looking for some real strong earnings growth on this company, and it's obviously very, very cheap. Does offer you a 2% dividend yield, and even in spite of COVID, it has a pretty good dividend record. It did freeze the dividend in the fiscal year 2022, going into 2023, at least it's expected to at this point. So that's also something to take into consideration when you're looking at this company. Its historical performance has been relatively weak relative to, let's say, comparing it against the S&P 500. But again, that had to do with the fact that air travel obviously was greatly affected, by COVID. So anyway, there's Air Lease Company. The next stock I want to look at is Amcor. This is paper packaging. It was a spinoff. Again, you can go into the corporate website if you're not familiar with it. They make packaging materials and things for corporations. It's been about a 7% grower. The stock price has tracked that. It's a little pricey today. Offers almost a 4% dividend yield. The PE is about 15.9, which gives it an earnings yield of 6.25%, which is not bad, but it's not great. I'd like to see this one a little cheaper. It is forecast to grow at its normal rate of 7 or 8%. It's a good quality company, BBB rated. So this is one you might want to take a look at. Just not a lot of history here. The next one on the list is quite interesting. This is Bank of America. I've covered the money center banks in the past. We saw how strong these banks were. And if I could draw this graph back another 10 or 15 years, which unfortunately I can't, you'd see that they've had a couple of decades of really strong numbers, and then they all got greedy with all the financial engineering and so on that happened that instigated the 2008-2009, I call it financial-derived recession. You can see how the stock price collapsed. It's been a little spotty coming out of that recession, but it's beginning to perform a little better. COVID did have its impact. You can currently buy it at a less than an 11 PE. Dividend yield of about 2.3%, earnings yield of about 9.5%. It's forecast to give you some really decent growth, almost 8% over the next couple of years. And the long-term growth here is considered to be about 5%. But the real allure here of this company is it's obviously Bank of America. It's an A- rated company. If you're willing to forgive the sins of the financial debacle, this would be a good entry point or a good time to start taking a look at it. From a standpoint of dividend growth, I think if you look at it over the last decade, which was, coming post, we can even go back a couple of more years if you would like, and look at it since the Great Recession, you can see that it's had a really stellar record of growing the dividend here more recently and at a very high rate. That's after it started to get its business back in order in its affairs. But again, look at these different time frames, and so you can evaluate what's really happening, because the fast graph allows you to do really strong analysis by looking carefully throughout the company's history. This is Blackrock. As I featured in my intro, it's the world's largest asset manager. It's been a very, very consistent grower. You can see the times when, they were less optimum times to buy it, but because of the growth rate of this company, even if you'd have paid these high prices back here, and even if you're looking at it, here in its low valuation, you would have earned around 9.5%. Of course, if you had the foresight and the, rational intelligence to buy it when it was cheaper, you could have made 15% on average on your money. Valuation matters, and it matters a lot. This one had gotten real expensive as this market had. I've been preaching that for a long time as Mr. Valuation. This is now an extremely high-quality company, AA minus rated, and it's come into fair value after having an abysmal year. This is perhaps the time to start being greedy when others are fearful. With the way this market's acting right now, I would also suggest you might want to really watch these stocks, but these stocks that have been out of touch or out of what I would call prudent investment reach for so long, it's nice to see so many of them coming into value. Bristol Myers has been undervalued for many years. It's obviously one of the largest pharmaceutical companies, A+ rated. Still buying at a 10 multiple, has almost a 3% dividend yield. It's been rallying pretty strong here recently. You can see in spite of the down market, we've had because I think it's so inexpensive, you've had some really good price action. The company's not expected to grow real fast going forward, but because you can buy it at a 10 multiple, I think the company is extremely cheap. The normal multiple has been over 14, the normal historical multiple that the market has added. And see, here you see a multiple of 17.8, but that was because you were including all these high multiple years. You shorten the time frame, and that's where you start to see the multiple, shrink, because in more recent times it's been undervalued for years and only trading at about a 12 multiple. So again, use the tool to analyze what you're looking at to help you make more prudent and sound decisions. Blackstone is another asset management company. I struggle a little bit with their dividend payout ratio. I don't know a lot about Blackstone. I haven't really studied it much, but you can see it's been somewhat inconsistent. The dividend record has been, somewhat spotty if I look at it from a standpoint of operating cash flow, because it does offer over 4% dividends. I find the cash flow suspect also. So, this is one that you'd want to take a much more serious look at if you were interested in Blackstone. And it's overvalued right now, in my opinion, although the price is moving back into what appears to be a more prudent valuation level. Caterpillar is a very cyclical company with a really strong dividend record. The company is, I think, moderately overvalued here. However, it is supposed to be growing pretty strongly over the next 2 or 3 years. So it would still be a reasonably decent investment with the markets acting like they are. And we're starting to see some downturn. We saw almost a 4% drop by the close on May 9th. This might be one that's worth waiting for, but keeping it on your radar screen as one that you might want to enter because their long-term dividend record has been excellent. Growing at somewhere between 9.5% and 10% a year. So Caterpillar is one. I'm long this stock. I'm not buying it currently because of its valuation, but I would be buying it again if it got a little bit cheaper, just so you know. Next stock on the list is CME Group. Again, I'm not real familiar with this stock. It's a financial exchanges and data company. Trades at a very high multiple historically. It's AA minus rated, pretty, good credit rating. The stock just looks to me like it's significantly overvalued. If I look at other metrics to see where the valuation is, I still get the same result. I get overvaluation no matter how I look at this stock. So it's one that I probably would not be interested in at this time, looking at it any further until I got much better valuation. But we have had a nice correction here in the last year. Capital Southwest, I really wouldn't be interested in this stock at all here because of the crazy data I have to shorten the time frame. It does yield over 8%. Asset management and custody, again, it's, I don't know if this is actually a hedge fund. I don't know what this stock is. They're middle market lending with a focus on relationships and responses. I went into the website here and you can look at, the team. You can look at their portfolio and learn more. If the dividend is what looks intriguing here on this stock, but, it's not really being that well covered. If I look at it from a standpoint of operating cash flow, I find it very, very suspect again, very inconsistent. If I look at it from a sales point of view, it looks a little better, but this is one that I don't know very much about, but you asked to see it, so I'm just simply showing you what it looks like on a fast graph. Dick's Sporting Goods, they, had a change in their contract with Nike. Otherwise, the stock was starting to look, real attractive. Coming out of COVID, it had some really good years. Going to expect it to have a down year this year, and that's bringing the stock price down. but it would be one that I think you might want to keep your eye on in the future, because once it gets past this year and it stays so cheap, it would be a good time to maybe start building a position in Dick's Sporting Goods. I do consider them a good long-term retailer. Next one would be Dow. This was a recent spinoff. I'm not really sure about this one. It looks cheap, but for some reason the analysts don't think earnings are going to be that great for the next couple of years. So again, I'd be cautious. The one attraction here is it's got a 4% dividend yield at a very low valuation, but it doesn't have much in the way of growth, so there could be bad news coming out on a stock like this. And again, we don't have a lot of history now because it's, brand new as a spinoff. eBay is morphing from a growth stock into a dividend growth stock. You can see its long-term growth has been over 22%. It's been 22%. You can see that the stock price tracked that again, sometimes getting overly exuberant, sometimes getting overly pessimistic. The company did start paying a dividend back in 2019. If you look at it's very undervalued right now. In spite of that, if you look at the long-term performance, it's outperformed the S&P 500, despite the fact that it's very cheap. But I want you to note, if I start shortening these time frames, my perspective changes. We still got 14.5% growth, but it does not look as cheap as it did. And here we're still at 13% growth. Future growth is expected to be about 7.5% to 8%. The long-term growth is expected to be about 10%. So keep in mind, part of the reset of this company is the fact that its growth rate is beginning to slow down. It's BBB plus rated, offers a 1.8% dividend yield, an earnings yield of over 8%. If you were going to be interested in eBay, now would probably be a good time to be building a position if you're looking for total return. Now, I wanted to show this stock. I was asked to show Ford. I'm not a fan of automobile companies. I really have never invested in them. General Motors, Ford, the rest of them, they're not bad companies. They make good cars, good vehicles, but they have a lot of trouble making money, and certainly making money for their shareholders. You can see this dividend record. You can't really trust that they're going to pay, so they're paying almost 3% now. Are they going to continue to pay that dividend in the future? What's their earnings going to look like? If you look at this stock going back to 2002, okay, if I run the performance rate from January of 2002 to May of this year, it generated less than a 1% total annualized rate of return. It paid some dividend spotty. It turned $10,000 into $7,892. This is not what I consider to be a strong buy and hold stock. You can see the earnings, the operating performance is very inconsistent. So I find this one, regardless of their statistics, which look pretty good, I find it, not a kind of stock that attracts me as an investor. FedEx is a good, solid growth stock. They did suffer a little bit with COVID. The stock is currently dramatically undervalued, trading at just over a 10 multiple, earnings yield of just under 10, dividend yield of 1.4%. It's expected to continue growing at 11% for the next couple of years, and long-term growth is expected to be 13%. So this is, I think, a very strong total return stock with a little dividend kicker for you. And I think now would be the time to be taking a position in FedEx. It looks very inexpensive to me. Looking at Genpact, this is another very good quality company, data processing and outsourcing. You can see how the price has tracked earnings in the long run, but again, it goes from being highly overvalued to, back and keeps reverting back to its fair value, which it's recently done. Offers a modest 1.25% dividend yield, trades at just over 15 times earnings, 15.8, has an earnings yield of 6.3. The company is BBB plus rated. I consider it a very strong company, a very good company, and it's within valuation parameters. Now, if you're interested in this company, this would be a time to look at it, but I might even be looking for some further deterioration. I'd like to buy this one cheaper if I possibly could, but if you look at it historically, when you got an opportunity to buy the stock, if you wanted to buy it, you had to, be willing to go ahead and step up to the plate and take a position. When you get the stock trading at these decent positions, you end up getting very good rates of return over the stock. And, it's actually outperformed the S&P on growth, slightly underperformed it on dividend. But again, the dividend, remember, has just started. So they haven't had all the years that the S&P has. They're probably actually throwing off a better dividend growth record than the S&P. So this is one that I think is worth taking a further look at if you're interested. Graco, which is industrial machinery, typically trades at a premium valuation. This is one I like to look at other metrics. It's, any of these dividend growth stocks. This is operating cash flow. If I look at it at its normal price to EBITDA, it trades normally at around 13 times EBITDA. It's currently trading at 17 times EBITDA. I would say it still looks a little pricey to me, but it is a good company that's worth watching as this price continues to drop, although it did rally a little bit yesterday. Next stock is Goldman Sachs. Goldman Sachs is obviously one of the more well-known investment banking and brokerage firms. It has a good record of growth, but also a lot of inconsistency along the way. Their dividend record has been probably the best part. They've had a nice growth of dividend and a very consistent growth of dividends at about 17 or 18%. So, that's one thing that's attractive. The stock does look very inexpensive today. Based on forecast growth, though, analysts are expecting a negative year this year. We're only expecting 3% growth, but that's because we're expecting a 38% drop in earnings this year, then back to 7 and then 13% growth. So, long-term growth is also expected to be negative. So the reasons why the analysts feel that way might be worth looking at. I haven't done that work myself, but if you're interested in Goldman Sachs at these levels, I think you really want to find out what the future holds before you made an investment. HDFC Bank is a very, high-quality bank. They did have a little bit of dividend issues the last couple of years, but otherwise they've been a very, very consistent performer. When you take the price off and just look at the stock from the standpoint of operating performance, you can see it's grown at over 19% a year. It's forecast to continue growing at 17% or higher. The long-term growth rate is over 20%. So this is one that's getting very, very attractive looking. It's a very high quality company. It's come off of its real high notes here. And so for the first time, this stock does look like it would be an interesting one for the next 3 to 5 years at least. So you might want to take a closer look at this company. You can see how the price has tracked earnings, but the market has put high valuations on it from time to time. That also can be an opportunity for you because when you're looking at forecasting, if you look at what a fair value 17 multiple would be based on its growth rate, and then you looked at the normal multiple, which has been about 25 to 30, you can see it looks a whole lot more attractive. That's also something that you can take into consideration when you're evaluating them. Honda Motor is one of the better automobile dealers that I've looked at, but notwithstanding, if you shorten the time frame coming out here, from just after the Great Recession, look at performance, you can see that you had actually lost money buying and holding. Honda has a little more consistency than we saw with Ford, but it's still a very, very cyclical company. When you look at the analyst scorecard, you find out that these automobile companies are extremely hard to analyze. So Honda is not one that, I'd be interested in, even though the metrics look great. 3% dividend yield, but it has a spotty dividend record. It's only trading at a PE of 7.3 blended. Its earnings yield is over 13%. But it's, again, does it have the kind of predictability you want to have as an investor? Intercontinental Exchange, ICE, it's known as, and this stock symbol is a very, very consistent grower, over 25% a year. It's recently, fallen dramatically in this market, I guess, with the threat of interest rates. It's, essentially a financial exchange. It started paying a dividend back in 2013. It's grown that dividend at a very astounding rate. However, if you cut a couple of years out of this, let me cut a couple of years out of the dividend here, you see it's averaging we'll call it double-digit dividend growth, and I think that's consistent with it. It's forecast to continue growing at about 8%, and the long-term growth is expected to be about 8.5% to 9%. So this is one that I would say is coming into fair value, but it's not quite there yet. It looks like it's very inexpensive here, but that's because it was sustaining these massive growth rates. Clearly now the growth of this company is expected to slow down, and it has slowed down if you look at more recent time frames. That's important to recognize. So we're looking at, long-term growth of 7 or 8%, maybe 9%. So you have to be rethinking yourself and not looking at this stock as what it traded at when it was growing so fast. You got to think about what it's going to be trading at, now that the analysts have this more muted expectation. Infosys is an IT consulting firm, very, very inexpensive, although that's starting to break. This is not one I want to spend a lot of time with. The dividend record, they do pay some special dividends from time to time, but I think this stock is just too expensive to worry about at this time. Although, it's starting to correct. So, if you were wanting to watch it, I'd look for a much cheaper price. I wouldn't be interested in this stock. Just put that into perspective until the price was like $10 or $11 a share, and it's currently trading around 20. So I consider it very, very overvalued. JP Morgan Chase, very similar to Goldman Sachs, a diversified bank, has a good dividend yield of over 3%, good earnings yield, trading at less than 9 times earnings. Historically, here in recent times, the PE's only been about 13. Normal, that would still give you double-digit rates of return going forward. It's an extremely high-quality company, A- rated. So, I would look at this stock and consider this stock if you're looking for either total return, dividend growth, or both. I think JP Morgan might be one that you'd want to take a look at, certainly as a high-quality investment candidate. The next one we want to look at is Kraft Heinz. This was the spinoff from Philip Morris. It came out very highly valued, and then, of course, that stock price has been settling back into numbers. The historical earnings growth here has not been real attractive either. It's actually been negative. So, this is one that has a reputation, but it's not expected to grow very fast. It does offer a 3.6% yield, a relatively low multiple, 15 multiple to buy it. But the fact that the company is not expected to give us any growth is what would really concern me here. I'm not really a fan of Kraft as an investment. Maybe you like their foods, their cheeses, but I'm not crazy about them as an investment. Manpower Group, somewhat cyclical human resource and development company. It's currently got very inexpensive. If you're looking to play a cycle, this would be one that's interesting because you've got a strong margin of safety. You got about double-digit growth expected for the next couple years. Long-term growth is expected to also be about 11%. So again, this would be a nice time to be looking at Manpower if you don't mind the cyclicality of the company. Manulife is one I was asked for several times. This is, again, looks a lot like Bank America did. Had really good growth going forward. It's life and health insurance. It really ran into a lot of trouble after the financial reset. If you look at the stock in recent years, since then, it's kind of got its mojo back, growing at about 9%. The company's forecast to grow at about 7.5%. Long-term growth is forecast to be 13%. I think the big thing about this stock is it really gives you a margin of safety of 4.7%, almost dividend yield. You can buy it at 7 times earnings. And even if you're only considering it a 10 or 12 multiple, if you look at it from a standpoint of what its normal multiple has been, you still got a chance to make astronomical rates of return over the next 2 or 3 years, buying this high-quality A-rated life and health insurer, Manulife. So I like it a lot, but there's a lot of stocks in the financial sector. Altria Group is having a real bad day today. I haven't had a chance yet to look and see what the news has been. It must be earnings announcement. We can check on that. But the last I looked at it, it was trading down about 8%. Yeah, it's almost 9% right now. I guess they're going to acquire the smokeless tobacco company, and I guess the market doesn't like that. I haven't really looked at it yet. I am long this stock. I will be doing my homework on this stock after I finish recording this video, but I think this stock is very cheap, offers a great yield over 6.5%. It's BBB rated, has a great dividend record, a great, very consistent operating record. So I think it needs to be looked at today, especially if you're an income investor and or a total return. Morgan Stanley, very similar to what we saw with Goldman Sachs and JP Morgan. A typical financial, it's improved greatly since the financial debacle has been over. Growth has been, strong again. Performance has been good. It is expected to have a down year this year. That's something to take into consideration. Long-term growth is only expected to be about 2.5%, but the stock is cheap enough to compensate you pretty nicely, even if that's true. Next one we're going to take a look at is PCH, Potlatchdeltic. I guess this is a specialized REIT. So obviously I have to go look at it from a standpoint of FFO rather than earnings. Don't know much about this company, but I don't like the historical record. I don't like what the analysts think is going to be happening going forward. So I would probably just overlook this one and just ignore it. I wouldn't spend my time doing too much research here. Prime America, now this is kind of a multi-level marketing insurer, life and health insurance company. People have criticized it for that, but it has one of the more consistent growth records, double-digit rates, earnings yield over 10%, blended PE of just under 10, a 1.87% dividend record. Even though it's so undervalued right now, it's had really strong performance against the S&P 500. This is one that, despite the idea that people don't like what they do so much, it's A- rated, very high quality company. This is the old buy term and invest the rest. I think they were the actual inventor of that. So, it's a company certainly worth looking at. It's more of a growth stock, in my opinion, than anything else. And I'm putting this one on my radar. I don't own it currently, but I am going to start taking a harder look at it because of its cheap valuation. Reinsurance Group, I'd have to know what caused all this. They are expected to recover strongly. They are A-rated. They're forecast to really recover very nicely, so you might want to take a chance here. The stock was down, pretty strong the other day. Moving on, Riley B. Financial. I wouldn't even bother looking at this stock. I don't know why I even left it in here. I don't have any real fundamental data on this company. I'm not sure what's been going on with it. And it might be something I'm missing, but I didn't bother to spend the time to figure out what that was. Snap-on, I've covered this before. Occasionally cyclical on occasion. It is expected to run into some slowdown here, shortly. Long-term growth supposed to be expected to be over 7%. I consider this very attractive at 2.6%. I do believe this company has good growth potential, and I do believe they have the ability to recover. So this is one you might want to take a closer look at. S&P Global, this is Standard & Poor's Corporation, one of the higher quality financial exchanges and data providers, obviously, in the world. It was very, very expensive, as you can see. It's beginning to correct into fair value territory. Looking at it from, some other metrics here, the stock just does still look extremely overvalued. But this is one, if you ever get the opportunity to buy it, I think you do, but I don't think the opportunity is here today. I think it's approaching that. It's starting to show up, but it's not really here today. Next one is Strategic Education. Not real crazy about these education services companies. You can see how cyclical. Dividend record has been sloppy. Earnings have been sloppy. I don't even consider it that cheap. And, it does offer what appears to be a 3.8% dividend yield if you can trust it. Their analyst scorecard is really spotty on both the 1 and 2 year forecast. So this is one that I'm not very interested in, even though it might have some decent statistics associated. AT&T was, obviously a big controversial stock. I am long this stock. The company did spin off, into their streaming business and so on. Excuse me, I'm just having a lapse in memory here, but the company that they're moving into, it's a really good one. They have spun off. The company is expected to recover. They're yielding 5.68%. They did cut their dividend, but they've essentially rebuilt their business. And I think looking forward, AT&T is going to start looking real attractive again. And I think it does look real attractive here. So this is one that I think is worth any dividend investor to take a look at. Truist Financial has been a pretty consistent regional bank. They did suffer, through the financial disaster, but not as badly as some of the giants. Since that time frame, they've been performing very well. You can see the stock price has tracked that performance. It's currently really undervalued at a 10.7 multiple, almost a 4% yield, and a really good record of dividend growth. So it's not perfect, but it has a good record of dividend growth. You might want to take a look at that. I'm going to be featuring T. Rowe Price probably this week. It's a dividend aristocrat, pays special dividends, as you can see from time to time. It's become very attractive, almost a 4% yield. So watch for my forthcoming video on T. Rowe Price, where I cover it in depth rather than just do these cursory. Toro is an agricultural and farm machinery company. You all know their brands. You've all seen their tractors and mowers and so on. So, it's an extremely well-known company. It has a very good long-term consistent record. It did, have a little trouble during the Great Recession, I like to call it, but it's really got its mojo back. It's coming into fair valuation territory. I don't think it's quite there yet. I'd give it a little time. I'd watch for it. But it's such a high-quality company, and the market has historically valued it at, relatively high multiples. You can see since gone out of the recession, it's been trading commonly at a 20 multiple. It's got almost a 15% growth rate. I really like this company. I just don't like the valuation as much as I'd like it to be. UPS, just like FedEx, has recently come into fair value. I think it's attractive now at a 3.35% dividend yield. Forecasted growth is about 6%. Long-term growth is expected to be 5.5% to 6%. this would be a good time to be looking at UPS. The market likes to put a premium valuation on this stock. I guess, it's A- rated. They like the quality of this company, and they like, with all the online business going on, and it's finally gotten to the point where it's not crazy overvalued. Verizon is like AT&T. It's been very inexpensive, but it's really been consistent. Its earnings growth has been consistent. It's considered, it's forecast to continue to grow. The big story here is margin of safety and undervaluation with a 5.25% dividend yield. So there you have it, ladies and gentlemen. It's Chuck Carnevale going through, quite a list of companies that you asked for here. I wanted to cover the ones that offered dividends and dividend growth. There were a couple really interesting ones in there. Blackrock comes to mind. T. Rowe Price, which I mentioned I'll be featuring. I did hope you got some sense of how to use this tool correctly. I think the FastGraphs Fundamental Analyzer software tool is just indispensable part of every investor's tool chest. You really ought to have it. I wouldn't imagine investing without it. So take a look at FastGraphs. If you liked what you saw today, ring the bell, subscribe to the channel, give me a like. And I want to thank you all, as always, for watching. I'll be doing part 2, where I look at some of the growth stocks you guys asked for this week. And hey, guys, you're wearing me out. There's only so many I can cover, but I'm trying to respond. I'm finding it interesting what you guys are looking at. So in that way, I'm having a little fun with this, but at some point, I might try to limit the number of stocks I cover. These are obviously very difficult. Anyway, thanks for watching.